Welcome again to the Stonebridge video series. This is the Efficiency Drivers series on forecasting the efficiency drivers. Hi, I'm Dan O'Connell, and this is the video that puts together all the prior videos in the Efficiency Drivers series. It takes 30 minutes or so to review the entire series. In sequence, the series summarizes how to identify cash opportunities in your business. The result is a stronger balance sheet and increased business value. We find up to 80% of all companies do not forecast their cash needs over a minimum of a 3-year period. Forecasting allows a company to recognize their history of how cash is generated and consumed in their business. Next, forecasting demands that a company isolate their cash opportunities and have a total look at how the cash drivers work together. Often we see companies that can't make investments in their business or reduce debt, and it is due to one or two items that are in plain view. Of course, you can have a forecast, but you also need to set goals and measure performance and variances and make changes that are necessary quickly to achieve the forecast. It is all about planning and tracking your future cash surplus or cash needs. Many companies have cash needs. That's why most companies have lines of credit. You remember the 7 cash drivers. The primary cash drivers are sales, cost of goods sold, and operating expenses. And the secondary cash drivers on the balance sheet are receivables, inventory, capital investment, and payables. In the prior Efficiency Drivers series, video 7, we totaled the extra cost and cash investment in this company we are reviewing. You see the extra cost to the cost of goods sold and operating expenses, and then the added cash investment in receivables, inventory, and payables to fund sales. This is the income statement for this company. The sales growth is double digits, but the gross profit margin is deteriorating. Operating expenses are creeping up and the operating income is decreasing. So where do we begin when forecasting? This table is a concise review of the 7 cash drivers. This is what needs to be forecasted. First, let's look at the historic performances of each cash driver. And then we can forecast our goals moving forward. The cost of goods sold had its lowest percentage of sales, which is 38% in 2016. Let's assume we can get back to the 38% and insert that amount into our forecast in the forecasted red box there. You will want to review these numbers and see what caused these variances and what you can expect in the future after setting up a process to achieve these goals. So we will continue isolating the best performance and inserting it into the forecast with operating expenses at 57%, accounts receivable at 35 days, inventory at 65 days, payables at 36 days, and capital expenditures of 0.2%. Now let's look at the new income statement. Here the gross profit contribution is growing and is at 62%. Remember, the gross profit contribution must cover expenses and profit. The operating expenses are controlled at 57%, which results in an operating income of 5%. For simplicity, we didn't consider any depreciation here because it was so minimal, so the EBITDA is the same as the EBIT or operating income. Now let's look at the cash management part of the business. We forecast and total the receivables, inventory, and payable changes and have the EBITDA after working capital changes. After deducting CapEx spending and applying a 37% tax rate, we see the forecasted cash surplus. Let's forecast the 5-year period, assuming the company was going to continue performing as it was. The cash deficit is growing for all 5 years. Now compare the as-is forecast with the changed assumptions. In the first year, we see a $450,000 improvement and a $600,000 improvement in the later years. This is an extreme example because we projected the company's worst year going forward, but the overall theory remains vital. Measure performance, forecast improvement, change, and prosper. The most successful companies go through this process. Forecasting begins by recognizing first where you have been and isolating the precise dollars of lost cash. Set up goals and forecast them. Continue measuring the variances and make changes as necessary, and see how the cash is impacted. This is the roadmap to future success. Every successful company has a good roadmap. Thanks for watching our video series. We encourage you to continue with the capital drivers series and the qualitative drivers, and how it all culminates in the valuation series and how the equity drivers impact business value. You can visit us at www.stonebridgema.com or call us or email with any questions. Thank you.